So
Hello,
you're going to do an
everyone.
introduction, Bianca? Or,
Yes,
sorry, yep.
that's okay. Hello,
Okay.
everyone, and welcome to our CCH Networks webinar, Implications of US Tax Reforms in Australia. I'm Bianca, and I'll be your moderator today. Your presenter today is Grant Wardell-Johnson, tax partner from KPMG Australia. In today's webinar, Grant will be sharing the implications for Australian business of the recent US tax reforms. You can submit questions via the Questions tab at any time throughout the webinar. I think we're ready to begin, so I'll hand you over to Grant.
Thanks very much, Bianca. I basically have 16 slides to go through, and I just wanted to make a number of comments in advance. One is some of the latter slides are quite wordy, and that's not normally my style, but there's some sort of detailed technical points that I know will be of interest to many people on this call, so I'm not apologising for that, but that's sort of hopefully will assist those interested in those areas of tax law. The second thing is I'm very happy to take questions on the way. So I have a screen in front of me which has my slides, but there's also a sort of a question and answer screen there. So please feel free to ask questions as we go, and I can address them or take them at the end. There's a question in relation to how US tax reform fits within the big picture. And I suppose until fairly recently, we've had strong cohesiveness or a desire for cohesiveness amongst the international tax rules, with increasing treaty network, up to nearly 3,000 treaties, the whole BEPS agenda sort of driving in some sense additional cohesiveness. And then in fairly recent times, we've had unilateral responses to international tax rules. The first major one being the UK DPT, Diverted Profits Tax, and that's sort of followed by an Australian MAL and DPT. So we did what the UK did in one tranche, in two tranches. And then there's the Indian equalisation levy, which some of you may be familiar with, but it's India's response to the fact that they were unhappy with the outcome in relation to action item 1 of the BEPS agenda. And it basically is a 6% tax on a gross payment on business-to-business data and digital transfers. And Europe is considering, sort of 5 countries are considering that form of taxation going forward. So we've had unilateral action rather than multilateral action in a tax space. And US tax reform has elements of that extend that unilateral action. Most of the concern in relation to DPT and equalisation levy, etc., has been based on the fact that maybe civil society is unhappy with the delineation drawn between selling within a country and selling to a country, particularly in the digital space. However, in the US, I think it would be fair to say that wasn't their concern, rather was or is to what extent this tax system actually encourage people to transfer activities outside the US as against perform them within the US. And that's very much a driver behind some of the US tax reform components. So the two things that really fall outside, if you like, the normal domain of international tax rules are the US base erosion, anti-abuse tax, and what's wonderfully named as GILTI, which is an acronym for Global Intangible Low Taxed Income. In response to those, 5 EU finance ministers, and that's UK, Spain, Italy, Germany, and France, wrote to Treasury Secretary Stephen Mnuchin and said, hey, these measures are in breach of WTO rules. And at the time that they actually wrote that letter, which I think was about the 11th or 12th of December, you had the BEAT proposal. Sorry, you had the guilty proposal, but you had a House version of the BEAT proposal, which was the imposition of an excise. Now, the Senate proposal, rather than the House excise proposal, ended up in the final package, but the concerns of the finance ministers remain in relation to both of those two domains, at least, and maybe some other domains. Another point I'd like to make is the reform measures have a very strong upfront benefit and a lower benefit in the back end of a 10-year period, which is the period of evaluation that Congress undertakes. The IMF has noted that, look, the world economy is expected to increase in terms of GDP growth. They, in terms of the US, they attribute a 1.2% increase in GDP to 2020 to the US tax reform, but then they see lower growth from 2022. So this is quite an important element of the Trump tax package. So in the US, you're starting to hear people talking about the Trump bump and the Trump slump, and how big will the slump be after this significant period of growth. Part of that is not just the reduction of the corporate tax rate, which is permanent and should affect the position fairly evenly over the 10-year period, but due to the expensing measure. So I'll come to the expensing measure, but broadly, it's 100% depreciation deduction, and it will entice companies to spend more in the first 5-year period, and then spend much less in the second 5-year period. And so that will lead to an economic, I suppose, mismatch between the early periods and the later periods. And the other thing is the increased deficit itself. So in the numbers that I will show you, the increased deficit is about 1.4 trillion over the 10-year period. You would have read numbers like 1.1, 1.2 trillion at various times, and that's because the Congress Budget Office estimated certain additional growth, if you like, as a result of the reduction in the company, reduction in US taxation, which has not been done by the Joint Committee of Taxation, and the numbers in the slide deck are the Joint Committee of Taxation numbers. But an increased deficit under classical economic theory would lead to increased interest rates in the longer term, which classically leads to less economic activity. So that's sort of the thinking behind the IMF, sort of the increased deficit and the expensing. There's a third thing that's being discussed at the present time, and that's because a number of companies have said we're going to pass on the benefits of the tax reductions to our employees. So there's the prospect of additional wage inflation, which may put pressure on the US Treasury to again raise interest rates. So in my view, and whilst I welcome a reduction in the company tax rate, this whole package, for the most part, does not provide long-term structural solutions to a difficult US debt problem. In fact, I believe it does the opposite, and I'll come to why I think that. I just thought I'd throw a slide in relation to the background, and if many of you would have followed what was happening, possibly at a distance, in sort of November and December of last year, and would have picked up different models in relation to some of the proposals, and there's a bit of confusion in relation to that, at least sitting in my mind. The start of this is a blueprint that was released in June 2016 from the Republican Party, really written by Paul Ryan and Kevin Brady. Paul Ryan is the leader of the House, and Kevin Brady is the chair of the House Ways and Means committee. That proposal also had the BAT, or the border adjusted tax, or whatever name you give to it, which was subsequently dropped. In parallel to that proposal, you had Trump election pledges, which actually changed throughout the campaign, but indeed became closer and closer to the blueprint as time went on. After failure of the Republicans' sort of desire to reform Obamacare, there was an immense pressure put on tax and to actually to get something passed by the end of the year. And part of that pressure is the midterm elections that are going to occur later this year. And it was thought in political terms that if the Republican Party didn't get anything through, there could be a significant wipeout in relation to their congressional, or the number of congressional seats that they held. A big six got together to provide a uniform framework, which they released on 27 September 17. The big six are two from the administration. It's just Stephen Mnuchin, who's Treasury Secretary, and Gary Cohen, who's, I think, chair of the National Economic Committee. Two from the Senate, Orrin Hatch, who's chair of the Finance Committee, and Mitch McConnell, who's leader in the Senate, and then Paul Ryan and Kevin Brady, as I mentioned. And basically what happened is you had this parallel consideration. So Brady released a proposed Tax Cuts and Jobs Act, and it didn't end up being called that, and I'll come back to why. And then basically that went to the Ways and Means Committee. There were amendments made in relation to that, but at the same time, the chairman of the Senate Finance Committee, Orrin Hatch, released his what they call chairman's mark. The House bill was approved by the House on the 16th of November, and the Senate Finance Committee released their amendments. The Senate bill passed. So you had different bills between the House and the Senate. So there was a conference agreement. The House passed the bill on 19 December. It was realized at that time, and possibly this was raised in the early hours of the morning on the 20th of December, that the bill might not satisfy the budget reconciliation provisions, which I'll come to. And so three measures was taken from the bill. One was its name, and then that was passed by the Senate, and the bill went back and passed through the House. And then on 22nd of December, President Trump signed the bill. The whole nature of this package is grounded in something called budget reconciliation. And generally, without budget reconciliation, a Senate can block legislation through filibustering. Filibustering is just continually talking such that the bill actually never gets passed. In 1974, Robert Byrd, who was a senator from West Virginia, put forward something that's been referred to as the Byrd Rule, or budget reconciliation, and it became part of the Budget Reconciliation Act. And in fact, it was an act designed to ensure greater responsibility and deficit budgeting by the US. The way in which the rule works is firstly, you need a trigger mechanism to unlock reconciliation, and indeed the Senate passed a bill to allow an increased deficit of up to 1.5 trillion for 10 years. But the important element of the budget reconciliation process is that it cannot, the measures which are in the bill, which are subject to budget reconciliation, cannot result in a net tax cut beyond the 10-year period. By net tax cut, I mean net of expenditure as well. And that's driven sunset dates for virtually all the individual measures and pass-through rules that I'll come to. So they are not permanent, and they cut out basically in 2025. And the reason for that is that if they were permanent, then it would breach this rule that you can't have a net tax cut beyond the 10-year period. The political logic is, hey, look, if you just introduce these tax cuts, it's very hard for a future government to undo them, and so they become politically locked in, even though they're not legally locked in. By contrast, most of the business changes are actually permanent, which is beneficial in one sense because there's some certainty in relation to what's happening. Just to give you the overall picture there. So here's the individual tax reform. The total tax reform here increases the budget deficit, if you like, by $1 trillion in the first 5 years from 2018 to 2022, and 1.456 in the whole period from 2018 to 27. So you can see that the measures are loaded towards the first 5-year period. And here I've split up between 3 headings, and they're the headings that actually appear in the Joint Committee of Taxation analysis of the bill. The bill is called HR1, actually. It was originally proposed to be HR 1, the Tax Cuts and Jobs Act, but the title itself was seen to be a breach of budget reconciliation, so they dropped that. So the final bill is actually HR1, which is about 185 pages. You can see individual tax reform there, 744, and then 127. And since virtually all the individual tax reform measures are sunsetted in 2025, if they were to continue after that time through a future government, then I suppose the impact in relation to the budget deficit becomes quite substantial indeed. There you see business tax reform, which is basically the domestic business tax reform, which is net negative. Most of that is actually company tax reductions to 21% from 30%, and then international tax reform is net positive in relation to that. So that's how you get those numbers. And as I mentioned, these are Joint Committee of Taxation numbers that don't include macroeconomic feedback. So let's look at the business domestic rules. So there's the total, and throughout these slides I've actually got the total of the 1074 and the 1456, and then how individual measures, etc., relate to that total. So you can just look at those going through there. So the main centerpiece in relation to this is the 21% corporate tax rate, down from 35%. And so it costs 621 in the first 5 years and 1385. And then there's the expensing item, and you can see the expensing items is sort of the cost is up front, but it's essentially a timing difference. Limit interest deductions to 30% of EBITDA. What I'm going to do is go through each of these, except where I haven't got an additional slide in relation to that. I'll just mention those, but we will discuss that. The modification of net operating loss deduction, which I don't have an additional slide for. Broadly, the current rule is you can carry back 2 years and you carry forward for 20. And within the alternative minimum tax, there's a 90% rule, so that you can't, in calculating the alternative minimum tax, you can't fully offset a net operating loss against future taxable income. You can only do that to the extent of 90%. Now, what's happened is they've repealed the corporate alternative minimum tax at a cost of 40 billion over 10 years, but they've introduced a new net operating loss rule. So they've denied the carryback except for farming, and they've got an 80% rather than a 90% taxable income limitation. So that's what they've done in that space. Now, dealing with some of those. So the domestic corporate tax, it applies from 1 January 2018. And so 31 December deferred tax balances will have to be reset. The law was enacted, not even substantially enacted, by the signing of the President Trump of the bill itself. So all interim and final accounts, and many will be final because they'll be calendar year ends. But if you don't have a calendar year end, then an interim account will have to modify their deferred tax balances based on this reduction from 35% to 21%. So if you've got deferred tax assets that you've booked, you'll end up with a significant write-down in relation to those deferred tax assets. If you've got deferred tax liabilities, you'll end up with a significant write-down in relation to those liabilities. So you'll be a winner in the latter case and a loser in the former case. Those changes will basically go through the account in which the deferred tax balance actually exists. So if it's for the most part, it will be in the P&L, but there will be some in comprehensive income and some directly in equity, not commonly. So where's this lead the US and indeed Australia? And I'll put down some comparative rates there. So India at 30, Australia at 30. Japan has announced a reduction from 30 to 20. China sits at 25. And the US drops to 20th in the OECD from being right up near the top. UK's sort of 19 is going to go down to 17, and there's Singapore at 17 and Hong Kong at 16.5. And I would maintain that Australia is now becoming pretty uncompetitive in terms of our 30% tax rate, and this puts additional pressure on us to reduce that rate. Query what India and other countries will do. South Korea's gone counter to the trend. In fact, they've recently raised their corporate tax rate, I think from 22 to 24, something like that. But virtually there's a complete international trend towards lowering corporate tax. In an article in about mid-December anyway, the Morning Star quoted the AFR, which wrote, the article was in mid-December, and an article on the 28th of Jan, with some Credit Suisse estimates of how the reduction in corporate tax rate will impact the ASX. And they said it would increase the profits within the ASX companies by about 620 million, with about 21 major beneficiaries, and clearly those beneficiaries are those with significant US interests. So expensing's the big one here. I think it's quite important. So they increased first year bonus depreciation to 100% rather than the current 50%. So basically you end up with an immediate write-off for plant and equipment. It applies to new and used equipment. I think unlike the present provisions in relation to the 50% rule, which doesn't apply to used equipment, except where you've acquired that from a related party. The property acquired, it must be property acquired and placed into service after 27 September 2017 and before 2023. And then there's a phase down of this provision from 2023 to 2026. So you get 80%, 60, 40, 20 over that period. Interestingly, qualifying property includes certain film, television, and live theatre productions. I just thought I'd put that in because I found that of interest. Taxpayers can elect to apply a 50% bonus deduction rather than the 100% bonus deduction, and they might seek to do that having regard to their NOL position or other factors, remembering that this is actually a timing difference for the most part, to the extent that the property is actually disposed of some future time. Acquisition is the date of the binding written contract, which is what you would expect. From an Australian point of view, one needs to consider M&A transactions, because in the US you generally have an option to treat an M&A transaction as an asset sale rather than a share sale. And so that rule and its interaction with this expensing rule may mean that one option or the asset sale option is actually more attractive than the share sale option. So currently, there's a provision which many of you will be familiar with called Section 163J, which is broadly their thin capitalisation rule, which is referred to as their earnings stripping rule. And under that rule, currently, there's a limitation of 50% of EBITDA. So it's basically a cash based model rather than an assets based model for thin capitalisation, and that 50% is being lowered to 30%, which is actually consistent with action item 4. So you have a tightening of your ability to claim interest deductions. Unlike our rules in terms of thin cap, the denied deductions carried forward under these rules, as is the case under any EBITDA type rule, because you end up with additional volatility if you have a thin cap rule which is based on EBITDA rather than assets or equity. So many from the Australian perspective with subs in the US will have to consider how they've financed the US, and it may require lower gearing. This is not just an international rule, so it's a domestic rule, and it actually falls under their domestic provisions. So if you've got companies that are lowly geared, there's probably make minimal difference in relation to that, but those which are highly geared or junk bond status, this could cut in to make quite a significant difference. Here's the business International. So they have they've introduced a participation deduction, which is effectively a participation exemption using a deduction mechanism, and that's reasonably costly over the period of the 10 years at 224. But to compensate that, and it more than compensates that, they've got this transitional tax, which applies to basically cash or earnings and profits in the form of cash or other assets being deemed to be distributed back to the US, and I'll come to that. And there's GILTI there and BEAT, which are two important measures that we need to consider. A few other measures, and there you can see, so it's a net positive raising money for the US Treasury, 188 billion in the first 5 and 324 in the whole 10. So what's happening in terms of the international dividends here? So they have 100% dividend received deduction, or DRDs become the new acronym, and that applies to a more than 10% shareholder, or 10 or more percent shareholder, US shareholder, where they have that interest is more than 10% in a foreign corporation. What it does, it applies to the non-US foreign sourced income portion of a dividend, and there's complex rules in relation to working out what portion is foreign sourced and what portion might be domestically sourced. In most cases, substantially all cases, I would have thought that income would be foreign sourced, where you just have a classic subsidiary in Australia, for example. But there may be circumstances where a non-US subsidiary actually has some income derived from the US itself. It applies to a domestic C corporation, so it doesn't apply to see-through entities. That's not a REIT or a regulated investment co. Interestingly, they've introduced an anti-hybrid rule. So to the extent that the dividend is deductible in the non-resident jurisdiction or foreign jurisdiction, DRD is not available. So I find that interesting. So if you had a MERPS, so mandatory redeemable preference shares, for instance, with the US, and that's pretty rare because of the territorial system that currently exists, and that's deductible because our rules in relation to hybrids haven't yet kicked in, then the DRD would not be available. Shares in the foreign company, there's a holding period, so you must have held them for 365 days in the 731 days before the dividend is actually paid. And you're probably aware that in the Australia-US treaty, there's a holding period anyway in relation to the reduction of withholding tax. It appears, though it's not 100% certain, that the rule be applied broadly. So if the foreign shares are held through a foreign partnership rather than directly by the US entity, you'll still be able to get the benefit of the 100% dividend received deduction. The DRD can apply to a share sale where a gain made by the sale of the foreign corporation is treated as a dividend under special US provisions, which may invite certain planning in relation to those. A pitfall there is the DRD reduces the cost base of shares that the US company will have in the foreign company, but solely for the purpose of determining the amount of a capital loss. So it doesn't impact the calculation in relation to a capital gain. And there'll be many people that will be considering reorganisations, and some of those will be moving from a branch to a foreign subsidiary. But there are clawback rules in relation to losses, inherent losses that exist where there's a transfer from a branch to a foreign subsidiary, and basically those clawback provisions apply where the losses were actually used in the US. So something to watch out for if you're reorganising. Here's the sort of the big one, this transitional tax, where there's basically a sort of a mandatory deemed dividend in relation to earnings and profits that are held overseas. So it's referred to as a transitional tax. So it's a one-time tax for the last tax year beginning before 1 Jan 2018. So it'll be a 2017 year for most taxpayers. It applies to specified foreign corporations. So the new acronym is SFC, and that's either a CFC or a company where there is a more than 10% US shareholder interest by vote or value. The or value bit, I think, is quite new in the compared to normal US legislation. So that might be something to watch out for. So what do? You take your post 31 December 1986 earnings and profits, and you have to look at it at two dates: the 2nd of November 2017 and the 31st of December 2017. So there's additional complexity in relation to that. But you take the higher level of earnings and profits. So it's not an option in relation to which one you use. You've got to do both calculations and take the higher level. And obviously, that was put in there by the draftsman to deal with potential planning where people knew what was going to happen after the 2nd of November and before year end. You exclude effectively connected income and previously taxed EMP, and there's really complex rules in relation to where you have an EMP deficit and how that's actually allocated. So the effective rate in relation to the cash component is 15.5% and the non-cash component is 8%. It's actually achieved through a participation deduction. So what they give you is a 55.7% deduction. Sorry, it's the other way around, that they allow a 55.7% deduction, or in the case which actually gives you a 15.5%, and the 77.14%. Sorry, it'll be inclusion. Which will give you an 8% effective tax rate. So that's just the mechanism by which they achieve that. What's included in cash? What you'd think, plus net accounts receivable and the fair market value of a list of certain liquid assets. So there may be a requirement for many of you that are doing this calculation to actually get a valuation in relation to the 2nd of November and 31st of December of last year in relation to certain liquid assets. Foreign tax credits are allowed in relation to the tax paid on the E&P, but it's basically haircut so that you only get a proportionate foreign tax credit benefit. It's based on a 35% rate, but adjusted sort of for the 15.5 and the 8%, if you like. You can elect out of this if you have NOLs, which would otherwise be used to reduce the mandatory inclusion, and you want to preserve the NOLs, so there'll be planning mechanisms around that. And here's another element of the unevenness with which these measures have an impact, and that is you pay the amount in installments and can pay early, but years 1 to 5 you pay 8%, year 6 15%, year 7 20%, in year 8 25%. So the plan back ends the additional revenue derived by the government. From an accounting point of view, you recognise upfront the liability in relation to this, so it's in one sense completely crystallised, even though the payment is spread over a period of time, and so there's possibility to discount that. But for the most part, it would be treated as a non-current liability because you can defer the payment for more than 12 months. There's within this rule, there's a quasi anti-inversion rule, and basically if you have an expatriated entity, and that's quite a complex thing as to whether you have one, then the effect of this rule is that you recapture the previously given participation deduction, which effectively brings the rate of tax in relation to these dividends, mandatory dividends, up to 35%. So that is something that one may need to watch out for, particularly if you acquire a US business and that US business has subsidiaries overseas, and then you don't want the subsidiaries held under the US. You actually want to do something about them by moving those subsidiaries out from under. You would need to consider this new rule in relation to that strategy. So here's GILTI, beautifully named Global Intangible Low Taxed Income. So it's basically an extension of the US CFC rules. So the policy intent here is that CFC earnings that are non-routine should be taxed in the US. It's again very complex, but GILTI is broadly in excess of CFC income over a deemed tangible asset income return, which is listed as 10%. It's adjusted for certain interest, and the calculation is quite complex. Once you've got this sort of GILTI amount, the US shareholders actually receive a 50% deduction prior to 2026 in relation to that amount, which effectively gives an effective tax rate for this deemed US income at 10.5%. And that deduction is reduced to 37.5% from 2026, which gives you an effective tax rate of 13.125% in relation to sort of the return that exists in the foreign subsidiary. US shareholders receive an 80% credit for non-US taxes which are deemed to be paid, and there's no carry forward provisions for foreign tax credits. So if you end up with a timing difference between US and non-US law, you can end up with double taxation. So what's the intention here? The intention is to drive ownership of intangible property to the US. And as I mentioned at the beginning, this is one of the things that the EU finance ministers were quite concerned about. This is another one which is really interesting. So whilst GILTI is designed to penalise non-US residents, this is designed to basically make exports of US goods and services cheaper. So what you do is you get an additional deduction for foreign derived intangible income at the rate of 37.5%. So giving an effective tax rate of 13.125%, and it falls to 21, falling to the deduction falls to 21.875, so it gives an effective tax rate of 16.4%, I think, after 2025. So related party sales are excluded. So the idea is that these are sales where it's going to third parties, although there are complex on-sale rules in relation to this. So ultimately, from this, you can end up with a structuring where you end up with a standard 21% tax rate on the fixed 10% return on what might be US depreciable assets or tangible property, and a 13.5%, or it's actually 13.125% return on any excess return attributable to the export of goods and services. So the inherent intellectual property or intangible part of those exports gets a concessionary tax rate. So that's actually quite an important thing. So when you think of the fact that the US have dropped their tax rate to 21%, they've also reduced measures which can even further lower that tax rate to something like 13.125%. The other one, and this is a negative one, is the base erosion and anti-abuse tax. This is the Senate version of the House rule, which was supposed to be an additional excise, and which you might have heard of, but not in the legislation, but sort of in the earlier consideration of these rules. It was designed to give a level playing field between US headed parent companies and foreign headquartered parent companies. Possibly it does the opposite. So it's been questioned by trading partners, as I mentioned at the beginning here, because it effectively denies deductions to non-US entities where deductions would be available for payments to similarly situated domestic entities. So it applies to non-flow-through vehicles. So it doesn't apply to S Corps or REITs, but C Corps. It applies where there's more than 500 million US gross receipts using a 3-year average for the group. So that's US gross receipts, not global gross receipts. What do you do here? You look at base erosion payments, and that's all payments that are deductible, except payments for costs of goods sold, which are paid to a related foreign entity, and there's a 25% test in relation to that. There are two interesting exclusions. One is if for transfer pricing purposes, you've adopted the cost method for services, and B, if uncertain qualified derivatives. So what you do is you take your normal tax liability and you modify it. You modify it by adding back all these base erosion payments. And then you take off your regular, you take 10% of that, you take off your regular tax liability. And if it exceeds a certain trigger point, and that trigger point is 3% for normal businesses and 2% for banks, then you have this additional base erosion anti-abuse tax. So it's again designed to bring activity onshore into the US, and not to have US companies pay related parties for certain services, although in the case of goods, most of those will be cost of goods sold. The exclusion for cost of goods sold doesn't apply to depreciable property. So this rule does apply for payments of depreciable property by a US from a non-US company. Okay, so international other. I just repeated myself there. So let's just go to individuals, and some of you may be dealing with salary packaging in the US and have sort of tax equivalence rules for HR purposes. So you've got a change of rate, which is nowhere near as dramatic as sort of some of the Trump plan. So some of the Trump plan was reducing rates from 7 that exist now to 4, and significantly lower than this. But where the Senate ended up with was sort of a new set of 7, which are all clearly lower. The standard deduction, and there's a standard deduction which I think is now $6,500 for singles, and that's almost being doubled. So basically, that's a tax-free threshold. There's a stack of repeal of personal exemptions, and you can see almost a direct parallel between the change of rates and the repeal of personal exemptions in relation to that, which will affect people in the socioeconomic scale differently. The next one is an interesting one. So you would have heard of pass-through rules in relation to the US, and basically you can have income derived by a pass-through entity, which is business income, and it can be taxed at the individual level, so it's not taxed at a company level, and then the dividends taxed at an individual level. So that's referred to as pass-through income. So there's a 20% deduction for qualified business income, but excluded from that are certain specified service trades. So it's based, health, and these are listed in the legislation, but health, law, accounting, financial services, actuarial services, theatre performing, theatre productions, etc. And the logic here is where the primary basis for the income is actually reputation. There is a de minimis rule, and there's a phase-out rule in relation to that. All of these, by the way, as I mentioned, cut off in 2025. So what happens after 2025 will be interesting. There's a doubling of a child tax credit. There's repeal of itemised deductions and changing of thresholds in relation to interest mortgage, which the US provides certain deductions in relation to interest on your own home or a second property. There's an increase in the alternative minimum tax exemption and a phase out in relation to that exemption. But again, that phase out disappears in 2025 to get this through the budget reconciliation process. And then there's a series of other provisions there. So what's to be done here? I think the whole landscape has changed for an M&E, and so they really need to reconsider, in many cases, where they've located certain functions, what their dividend policy might be, what their cash treasury policy might be in relation to these new rules. So previously, optimal structures are quite unlikely to be currently optimal. The participation exemption is going to have a significant treasury impact. So whereas many US multinationals just held their cash offshore because they didn't want to pay the additional tax at 35% on repatriated through repatriation, that will change completely. So a major company a few years ago, you've probably got an iPhone sitting in front of you, they had 140 billion offshore, parked offshore, yet they still borrowed in the US to actually pay a dividend or do a capital return. That type of planning won't exist going forward, because people use the dividend exemption or participation exemption to get cash back to the US. What these rules have done have created new anomalies between the taxation of companies, branches, and branches. There's no equivalent to 23H in relation to these US rules and CFCs. And so those anomalies are going to have to be considered to find the best structure. the corporate tax rate expensing, the FDII rule, which is pro-US, and the GILTI and the BEAT, which are anti-foreign, will drive operations to the US. How quickly or rapidly is quite an open question, but I note in the paper recently there's a company that was based in Singapore, and they said, no, we're moving to the US in relation to this. So even companies where the tax rate is even companies located in a country where the tax rate is below 21% might consider what they'll do. New calculations will be required, so I suspect to the extent that many of you are sort of managing Australian subsidiaries of US companies, you will have to do the calculation in relation to the mandatory transition tax, the mandatory dividend. The rules themselves, and it stuns me, is how complex they are, and how sometimes, in the KPMG commentary, they say, well, this doesn't match that rule. And that, of course, creates opportunities and pitfalls where you don't expect certain things to happen, and they do happen. And then finally, there is this big question as to what does this do to the Australian corporate tax debate, and whether, and I think we are, moving further behind, and will be damaged in the long term in relation to our high corporate tax rate. And I realise that's contentious. One of the difficulties with corporate tax reductions is usually what economists call the half-life of the benefit is quite long. So, it could be 7 to 10 years. And some of the modelling in terms of the Australian corporate tax reductions show that sort of half-life. So you get half the benefit after a period of 7 years, which is quite a long time. I think the way in which this US tax reform is being done, particularly in terms of the expensing, but also other areas where you have upfront benefits and down the back detriments, it sort of undoes that 7-year time frame, and you'll have much shorter time frames in which the stimulus to the economy will occur. But as the IMF predicts, it will be reversed in the longer term. So I do have some questions that have come up on the screen, so please feel free to add them now. Going in reverse order, yeah, I'll PDF the slides for you, and I'll send them to Tony here, and then he can send them out. Do transitional taxes apply to a US LLC which holds an Australian PL company? So the answer to that, I think, is yes. So the Australian company will be a CFC, and so they will be, if I can flip the side there, a specified foreign corporation, and so you will be deemed to have that dividend. In other words, you don't avoid the transition tax by long chains. And all this radical change and additional deficit, but no GST, have they missed the perfect opportunity? I mean, most tax economists would really love to see a much stronger consumption-based tax in the US, but that's politically very, very difficult to achieve. Introducing new taxes is very hard. When the BAT, Border Adjustment Tax, was furnished in the community, the Retail Trade Association in the US ran a campaign against it, and you just realized how hard it would be to do anything to change, because they focused on the fact that we have enough taxes, we don't need a new tax. So it would be very hard to put that GST in place, particularly because different states have different consumption taxes, and the federalism in the US, it's a difficult structure to actually deal with that. So if there are no other questions, I might hand that back to Bianca. I hope I hope it's useful. All tax reform is complex, but this is amazingly complex. And the US have a specific way of doing things, and the interactions between various parts of this new legislation will present opportunities and pitfalls. So I recommend that you, get advice, detailed advice from US advisors before you consider doing something, or just to make sure that you're doing the right thing in terms of the calculations that you're undertaking. If any of you would like to contact me, I've got my email address at the end of the slide deck, so please feel free to do that if you want clarification in respect of any of the points I've made. I'm very happy to deal with that, although I mightn't know the answer because I'm not a US expert, I'm just an Australian person looking in from the outside. Bianca?
Thanks, Grant, for today's webinar. And to all our attendees, hope you have a great afternoon. Bye.
Bye-bye.